Hopefully by now you've watched my overview of long-lived assets. Now let's actually take a look at how to record some of these transactions involving long-term assets. Take a look at this photo right here. It's actually my daughter making a pizza in a pizza restaurant, and this pizza restaurant had to buy this conveyor oven right there. So let's just assume that they paid cash. What does that acquisition look like? We might have an account called equipment or kitchen equipment or something like that, but we're going to make a debit entry to a long-term asset account. How about if I label that as a debit? And assuming we paid cash for this oven, cash goes down with a credit entry. And it's just that simple. Recording the initial cost of a long-term asset is typically not a very complicated endeavor. Oh, sure, we could complicate it slightly by saying that the company paid $25,000 of cash and financed the balance with a note payable. And that certainly would add a level of complication. Or we could have had some additional transactions for installation, shipping to get the oven to our location. Some of those types of costs, I suppose, are possible. But at its core, once you've identified the cost of the asset and you know how you're paying for the asset, it typically is debit the asset account and then credit cash or some type of liability account. Once we have acquired the asset, now it's on the balance sheet. In this case, the equipment account would have a $45,000 asset, but we know that that asset should not stay on the balance sheet forever. What we need to do is we need to estimate the benefit that this asset is providing over future periods. And it's an estimate. Okay, accounting is full of estimates. And sure, we might wish to have some exact number, but oftentimes that's just impossible or impractical. So we come up with an estimate. Let's say that we bought this oven right at the beginning of 2018. And I'm making it right at the beginning of the year to make the math easy. The reality is this depreciation expense that we're about to calculate, we would have to prorate it for the year if we had purchased this oven somewhere in the middle of the year. And let's assume that the estimated useful life of this asset is 5 years, okay? Which we can debate whether that's an appropriate length of time. Should it be 5 years? Should it be 6 or 7 years? These are management's judgments. Of course, if the company receives an audit from an external auditor, then the auditor gets to evaluate management's judgments. So, but 5 years seems to be pretty reasonable, somewhere in 5 to 7 range. 5 years makes the math easy. Now, the last thing we need to talk about as far as the calculation of our annual depreciation expense is something called a salvage value. Now, a salvage value is yet another estimate. We're estimating that at the end of the useful life, this asset may have a value of $5,000. Think Craigslist. Think Facebook Marketplace. Okay? We think that we could sell it for $5,000. Of course, we don't have a crystal ball. It's an estimate. So what you're seeing here is that the depreciable cost of the asset is $40,000. And if we divide that by 5 years, we come up with a rate of $8,000 per year. Okay? So we're going to systematically depreciate this asset at a rate of $8,000 per year for each of the next 5 years, assuming that we hold on to the oven for that long. So we get to New Year's Eve 2018, and what we see here is that the journal entry will be this right here. Depreciation expense. So this will reduce our net income for 2018, reduce it by $8,000. We debit that expense account, and then we're going to have something called accumulated depreciation. I'm abbreviating it, but I'm sure you can work with me. Now, with this accumulated depreciation, it's a contra asset account. It's a negative asset. Any contra account has a balance that is opposite the normal balance of a related account. So in other words, what you're seeing, and I'm going to show this to you in a minute, is that on our balance sheet, after this depreciation entry has been recorded, we're going to have a $45,000 equipment balance, and then we're going to have an $8,000 subtraction. And that's going to net out to a smaller amount, the net book value of this equipment on our balance sheet at the end of the year. As I promised, let me illustrate this to you. When we initially purchased the oven, so on January 1, our balance sheet looked like this. We had an asset called equipment with a $45,000 amount assigned to that asset, and accumulated depreciation, that contra asset or negative asset, had no value. We're kind of unrealistically assuming that this is the only asset of this business. Obviously, you can see other assets in this picture. But for illustration purposes, let's just assume that this is the only asset. So immediately after acquisition, the total non-current assets, sometimes we would call this the net book value of the assets, is $45,000. After we record the depreciation expense entry of $8,000, what you can see is now the net book value of this asset is $37,000. It's lower. That's because on our 2018 income statement for the year ended December 31, 2018, we're going to have an $8,000 expense recorded on that income statement, the using up of this asset, the allocation of this asset to this particular year. And then we see that the total net book value drops by the amount of the depreciation expense for this particular year. And we can expand this illustration. Now, we're not really consuming the asset so much as we are allocating it to future periods with this estimate of $8,000 per year. So take a look at the balance sheet excerpts for this one fixed asset. You already saw that at the end of 2018, this is year one of operations. The net book value is $37,000. And then what's going to happen is each iterative year, the net book value is going to drop by $8,000. Going from 37 to 29 is an $8,000 decline. Where did that come from? Well, it came from the additional depreciation expense we recorded during the 2019 fiscal year. And when we recorded the 2019 depreciation expense, that means our accumulated depreciation grew. Just in general, the formula is going to be this in our particular example. Debit depreciation expense for $8,000, and then credit accumulated depreciation for $8,000. We're going to make this journal entry each year at the end of the year for these 5 years. Every time you do that, your accumulated depreciation grows. Now, on each one of these individual income statements, if you were to look at the income statement for 2018, depreciation expense will be $8,000. For 2019, depreciation expense is $8,000. And the same will be true for these years over here. But the accumulated depreciation in the balance sheet, it grows like a snowball, getting bigger as it goes downhill. You can see the accumulated depreciation growing. It's accumulating, just like snow. And the net book value drops at a rate of $8,000 per year each time we record those expenses. Now, what you can see at the end of the 5-year estimated useful life, remember that salvage value of $5,000? We have depreciated this asset down to its salvage value. So after 5 years, the net book value of this asset will be $5,000. That doesn't mean that we had to sell the asset right then. There are plenty of examples where a company has some net book value, a fully depreciated asset, and they continue to use the asset for a number of years. That's because this depreciation expense is an estimate. Now, one note about salvage value. A lot of times in practice, in the real world, if you will, companies simply don't assign a salvage value. So what they would do in this case is they would basically say, well, okay, if there's no salvage value, we'll just depreciate the entire $45,000 over 5 years, and the depreciation rate will, of course, be greater than $8,000, and the net book value would decline at a rate of $9,000 per year. And then when you get to the end of the useful life, you got a big goose egg, and the net book value will be zero. That's definitely more conservative than assigning a salvage value, and that often aligns with what a company needs to do for income tax treatment, where they would be fully depreciating this asset over its life. Speaking of getting rid of a fixed asset, let's consider this example. At the end of 3 years, so we've used this oven for 3 years, we decide to sell the oven. Now, immediately before the sale, this is what our balance sheet looks like. $45,000 in equipment, $24,000 in a contra asset called accumulated depreciation, and the net book value is $21,000. Now, if you've watched any of my videos before, this will be familiar territory for you. This is my cheat sheet with debits and credits. And yeah, if you've watched some of my stuff before, this will be review. If you have not watched one of my videos, then you should know that I think this is a useful tool for remembering the debit credit rules. And the reason I'm putting this here is the journal entries to dispose of a fixed asset are a little bit complicated, and I think that understanding the debit credit rules helps you master these type of transactions. So assets go up with a debit, down with a credit. Expenses go up with a debit and down with a credit. And the other three, liabilities, owner's equity, and revenue, those behave the opposite. Owner's equity is a general term. In this case, it would actually be members' equity because it's a limited liability company. The owners of LLCs are called members. If it were a corporation, it would be called stockholders' equity. I've generalized it to owner's equity. As you can notice, this mnemonic, it's very soothing. Aloe. Now, back to the transaction. Let's say that we sell this oven for $21,000. How are we going to record this transaction? Well, from a fundamental standpoint, what we're seeing here, there's going to be neither a gain nor a loss. And that's because we're taking one asset, the net book value. Now, of course, this net book value, it takes two financial statement accounts to record that net book value. That's why it's called a net book value. It's one account subtracted from another. Accumulated depreciation subtracted from equipment. So the net book value of equipment is going down by $21,000, but we're exchanging that for cash proceeds of $21,000. So our total assets are going to be unchanged. Sure, the composition of those assets will be different. We're going to have more liquidity because we're getting rid of a non-liquid asset and we're turning it into cash. Of course, behind the scenes, we have to remind ourselves that we can't bake pizzas anymore, which could be a problem for our business, but that's a discussion for a different day. So how do we construct this journal entry? I always recommend, especially when you get to some of the more complicated journal entries, start with the easy part first. There's usually some component of a journal entry that just clicks, that makes sense to you. And if it were me, it would be debiting cash for $21,000. Because if you sell that asset, you're going to receive proceeds from the purchaser. You know that your cash account is going to increase by $21,000. Now this is where it gets a little bit trickier. Remember, this asset is going away. So what that means is this. Yes, your equipment account is going to decline. Okay. See what I'm doing here? Equipment is an asset. And since this equipment, the oven, is going away, we're recording a credit entry to equipment. That's going to zero out. But by doing that, that credit entry will effectively make this account have a zero balance. But we're not done. You see, the accumulated depreciation needs to go away as well. So let's do that. Now, accumulated depreciation is a negative asset. So right now, accumulated depreciation is a credit balance. If you want to make a credit balance asset turn into zero, we're going to need to make a debit entry to accumulated depreciation. That is the entry that's going to cause accumulated depreciation to go from a $24,000 credit balance to zero balance. If you take this right here, that will become a zero balance. Now, one of the reasons I like to focus on the journal entry is that you can double check yourself. Over here, we had determined mathematically there would be no gain, no loss. Great. And you can see, recording this transaction in our financial statements, we indeed have neither a gain nor a loss recorded here. So nothing is impacting the income statement and our journal entry balances. These total to $45,000. So your total debits are $45,000. Your total credits are $45,000. Certainly you could have a journal entry that's balanced and still has errors, but in this case, it balances, and you can see cash is going up, accumulated depreciation is going away, and so is the equipment balance. Now, what we're going to look at next is a couple of situations where we don't sell it for $21,000, we sell it for either more or less, and in those instances, there will be a gain or a loss. Let's explore a circumstance where we dispose of the asset, but we record a gain on the transaction. Now, I've kept most of the structure of our previous discussion, where there was neither gain nor loss, because really all we have to do is build upon this concept right here. Now, we're still getting rid of the net book value of this oven. At the end of this transaction, we still want our equipment account to have a zero balance. We still want the accumulated depreciation account to have a zero balance, and that will produce zero net book value, at least for this one particular asset. Because making a debit entry to accumulated depreciation for $24,000 will erase this 24 grand. Making a credit entry to equipment for $45,000 will erase this $45,000. So what you see is any disposal transaction for this particular asset is going to involve this debit to accumulated depreciation and this credit to the asset account, equipment. That's not going to change. But what if we sell this asset for $25,000 instead of $21,000? Okay, well, let's first of all see how that impacts our gain or loss. Now we're trading a $21,000 asset for a greater amount, for $25,000. Our company is better off at this point, at least because of this one transaction, because our balance sheet is going to show an increase in assets of $4,000. We did have a $21,000 asset. We turned that into a $25,000 asset. Guess what that means? We're going to have a $4,000 gain to record because we're better off. So what we're going to see down here recording the transaction is we're not debiting cash for 21 grand. It gets debited for 25,000 because the reality is we received 25,000. And if you do the math on this, now we have total debits of 49,000. We have an unbalanced journal entry. That's because we also need to record this gain. And sometimes this might be called gain on sale of equipment or something like that. But the biggest thing is this takeaway, is that what we're seeing is now on the income statement, because this is going to make, on the income statement, it's going to make our net income bigger. We're going to show a $4,000 increase to our profit for the year ended December 31, 2020, because we did profit from this sale. Okay? We didn't maybe intend to originally, but we were able to sell this thing for more than its net book value. Oh yeah, we could have some discussions about maybe our depreciation method was too aggressive and the net book value shouldn't have been that low or whatever. But at the end of the day, what you're seeing here is that the cash is going to increase by $25,000. The net book value portion right here is still going to be the same entry, but now we get to record this gain on our income statement. Finally, let's look at a circumstance where we sell the asset at a loss. Now, I've kept a lot of the same things right here on the screen. We're still going to be making a debit entry to accumulated depreciation to get rid of it, right? To get rid of this $24,000. And we're still going to be making a credit entry to the equipment account to get rid of that. Because if we make these two portions of the journal entry right here, the net book value will drop to zero, which is what we want to have happen because we don't have this piece of equipment anymore. The net book value should be zero. In this instance, however, let's assume that we sell it for $17,000. Now what we're doing is we're taking an asset that was on our books at $21,000 and we're trading it for a different asset that's on the books or will be on the books for $17,000. The math is not particularly complicated. That's a $4,000 loss. So what we need to do is we need to record a loss down here. Now, we can start with the easy part. Cash is going to increase if we sell it for some proceeds. That cash increase will be $17,000. But what you can see right now is that if you add up our existing debits right here, right now these total up to $41,000. And you know that a journal entry has to balance. If debits don't equal credits, the earth stops rotating, okay? I think you've learned that this far in your study of accounting. So what do we have to do? It's out of balance by $4,000. Well, no coincidence, it's this $4,000 loss. Now look what we're going to do. We're going to record a loss, and yes, this might be called something like loss on disposal of equipment or something like that. I'm kind of shortening it for this video, but we're going to record a loss. Look what a loss behaves like. If you debit this loss account, it behaves like an expense. It's going to make our net income smaller for the year ended December 31, 2020. And it should, because our net assets decreased by $4,000. We did experience a loss relative to this transaction. Remember in the previous transaction when there was a gain, we had credited that gain? Well, look what it looks like to credit a gain. Kind of behaves like a revenue. So in the previous transaction, when we had sold this asset for $25,000 and we had a $4,000 gain, crediting the gain account actually made the net income bigger because it behaves like a revenue. Same kind of behavior. In this case, where we have the loss, it behaves more like an expense, and it's going to reduce our net income. Now, of course, we could have discussions about, did we use the right depreciation life? The estimated useful life. Did we use the right depreciation method? Because it looks like we were a little bit off. But at the end of the day, remember that depreciation is simply an estimate. It is rarely going to be exact, but having a good, reasonable estimate is better than no estimate at all.